Good evening, everyone. This is Henry Gamble with SimplerOptions.com, and in today's free video I wanted to give you some insight on how I will be trading essentially the next 18 days. So as an options trader, I'm always thinking in terms of typically monthly expirations. I focus a little more on those, more so than the weeklies, and I think this is getting into be a decent point where we may be able to work some of those strategies in the October monthlies. The first one I wanted to come in and take a look at is Tesla. Now, part of the reason why I like Tesla is because I feel like the 250 level is a big psychological level, and more so than saying I feel that, just come back and look at it, where I spent a good chunk of time consolidating in this zone. Another thing about this is that it's a very mixed pattern, because from one perspective you could argue the pattern of higher highs and higher lows based off here, but then of course you can't ignore that it's still a good bit off of its all-time high. This type of pattern to me sets up to be very range bound. So in light of that, what are some plays that you could look at doing? I always like to bring over an options chain, and as you scroll through this, one of so many things that you want to pay attention to in this environment, but one of course is don't omit the fact that a lot of these companies are going to have earnings on the horizon. So if you're trying to do, because you see the big flush in the markets, okay, we want to work on selling premium. Selling that premium is going to be very tough if you're doing it in a series where it's going to continue to rally based off their earnings. However, if you come back and take a look at these that are 18 or 11 days out, I think this is a great place to work these because you're far enough out that you'll be able to take in some premium, but you are not so far out that you're seeing the impact from the implied volatility around earnings. I like seeing that the IV percentile is above 50%. And this is where I would start working these. The other thing that I love to do is say, okay, we step out into October and we say the expected move is, let's just call it $25 for easy math. And let's say we're trading at 250. Well, then that would imply that you do something like selling an iron condor. We start off with the 275 call and buy the 280 as protection. Then you do the exact same thing on the what would be the bearish side or the put side. We start off by selling the 225 and then buy the 220 as protection. This creates a nice balanced fly inside that range. You're looking at about $1.42 credit, so I would try and sell that around $1.50 and take profits around 75 cents. But more what I wanted to show is that once you price this iron condor out in relation to the expected move, so you immediately have the probabilities in your favor, then take a look at 225 and 275 into how they relate on the chart. So we come back here and we say, well, 225 is below the 200-day moving average, not to mention it's also below a fire line, so we're kind of adding technical backing to our probabilities of expiring, and that's what I like to do. Then you flip that and say it on the other end. Okay, 275 would mean that you had to take out this previous swing high, and then of course at that point that would change. But until then, you're setting it up to where you've got decent technical resistance, decent technical support, and I think that's a great way to look at some exposure in these markets as opposed to just being outright completely bearish. So I hope that helps, gives you guys some ideas on how to manage your positions over the course of the next several weeks. We're going to have a lot going on in the chat room and in the premium videos, so if you guys find them helpful, hopefully I will see you there at one of our future updates. Have a great night, and I will see you then.